Hello everyone, in this video we'll be beginning with a new chapter of CMT level 2, and the name of the chapter is a stock market model. Before watching this video, make sure that you've checked the previous chapters. In case you haven't, then I've given it in the link. I've given the link in the description box below. Alright, so this is going to be a basic chapter, but whatever we're going to learn is actually a very basic concept, but then since we haven't really studied this before, it might be a little bit tricky, and the only reason you'll find it tricky is because it's really lengthy. I might cover it in two parts or more or less. Let's see how it goes. So the learning objectives are defining an environmental model, contrast internal and external indicators, and sketch the basic components of Davis Fab 5 model. Fab 5 model is the most important concept when it comes to this chapter, and it will for sure be tested in your examination. I can hear Ned telling his partner Eddie Mendel at the dawn of Ned Davis research back in 1979 that he would need only one programmer for 1 year. For over a decade, Ned had been charting his favorite indicators by hand, and the work was becoming overwhelming. There were many more indicators to chart and not enough time in a day to do so. And as Ned has pointed out, he not only needed better charting, but more importantly, he needed to replace subjective trading decisions with a more objective approach. So he hired a programmer and challenged him to create a software that could not only draw effective charts, but could also analyze markets in a rather unusual way. Together, they developed the concept of timing models, and these models formed the basis of NDR's core position in a variety of markets and economies. It turns out, however, that predicting that he'd need just one programmer for 1 year was Ned's worst call. Today, we have an IT staff of nearly 30. As Ned has pointed out many times, the bane of the investor is the big mistake. On the following pages, I detail the makeup of one of our major models, the Fab 5. The goal of NDR model is to keep us open-minded and disciplined, and to let our profits run while avoiding big mistake. Okay, so whenever you're confused with what NDR is, it is basically Ned Davis research. Okay, that is what is the NDR approach. We realize models can be quite fickle no matter what their ingredients are or how they are built. This model is no exception. The game is to recognize potential capriciousness and pay attention to the effectiveness of each individual component and to the overall mix of indicator. One must always be vigilant when depending on models. The Fab 5 is an environmental model that uses what we call modes. Its job is to assemble the major internal and external factors that affect markets and combine them to produce a single objective verdict: bearish, neutral, or bullish. Offering only three possibilities might seem a bit too simplistic, like asking someone to rate a product on a scale of 1 to 3 instead of 1 to 10. But the goal is to keep things simple. And as you will see later, each mode can be open to subtle interpretation. To quote Ned, the evidence is rarely black or white, rather shades of grey. Just what is an environmental model? In a sense, it's one that can risk at arm's length without sacrificing too much on the long side. Such models effectively gauge how good conditions are for investing. Do we have calm waters, or are we about to enter the lower 40 latitudes? An environmental model takes into account what the Federal Reserve is doing, what the so called smart money. Just a second. Okay. So the environmental model takes into account what the Federal Reserve is doing and also what the smart money people are doing and how speculators are feeling, what interest rates and inflation are doing, and above all, what is the primary trend. So all of these things are the most important things when it comes to trading, and the environmental model takes into account all of this. Using a weight of the evidence approach gives us an educated feel for the risks in the market. The environmental model job is not necessarily to give concrete buy and sell signals. Its job is to measure the level of risk in the market. Before we examine the Fab 5 in detail, let's briefly discuss some of the indicators we use to build models. We look at two types of indicators: internal indicators as well as external indicators. Now, what are internal indicators? Internal indicators relate to price action of a market or index and include the usual list of suspects along with a multitude of variations. So, whatever the price action indicators are, like moving average, momentum, advances and declines, volume trends, etc. All of these can be found in the bottomless bag of tools used by the creative technical analyst. I've seen enough momentum tricks alone to last a career. Ditto for moving averages. There seems to be no end of possibilities when it comes to manipulating an index or its components in order to come up with so called objective opinion on market's direction. We break down internal indicators into two types: trend following and trend sensitive. So, you know what internal indicators are? Internal indicators are basically the price action indicators which we are using in the market. And when I say price action indicators, it means moving average, momentum indicators, and so on. And when we talk about the types, or when we talk about the types of the internal indicators, then they are basically trend following and trend sensitive. So, what exactly is trend following indicators? Trend following indicators keep us in harmony with the market's primary trend. And with enough weight in a model, they act as a stop loss when needed. Used well, they can help investors let profits run and cut losses short, basically following the trend. These indicators include moving average, crosses, and slopes, and some measures of momentum used either alone or aggregated. Trend following indicators are rarely neutral and can generate great returns, but sometimes give notoriously false signals. By their very nature, they are very late. Consequently, they require patience. Now, that is what is basically the trend following indicators. But what are trend sensitive indicators? Trend sensitive indicators are also known as overbought or oversold indicators, include mean reversion, momentum variations, and deviation from the trend. They basically give you the opposite kind of trades, right? That is trend sensitive. These indicators have a tendency for picking the tops and bottoms. That's how you use the RSI and stuff like that. So that is what is known as the trend sensitive indicators. They are very accurate but not adept at generating significant gains. Since they spend a good part of the time in neutral zone, they tend to work well in multi-indicator models, asserting themselves only at potential extremes. All right. Rounding out internal indicators is market breadth, an extremely useful tool in determining the technical environment. At NDR, we gauge this by watching the AD data, advances, declines, and unchanged, new highs and new lows, percentage of stocks, percentage of stocks in a universe meeting a specified criteria, above or below the moving average, volume data, combinations of AD, and so on. So, rounding out the internal indicators, what does the rounding out of internal indicators mean? It means that we are talking about the market bet. Okay, we know what market breadth anyway is. um, Over the years we've developed our own stock database. We use only common shares for our calculations in order to get a pure view of the stock market that's unsullied by closed end funds, preferred stocks, structured products, and so on. One day recently, 3,164 securities were being actively traded on the NYSE, but only 1965 of them were common stocks. In fact, nearly 40% of the actively traded securities listed on the big board aren't common stocks. So we just saw what internal indicators are. That the internal indicators are all the price action indicators. We have two types of internal indicators. The first thing was trend following, and the second thing was trend sensitive indicators. After we did that, now we come to the external indicators. And what exactly are external indicators? Now, external indicators are indicators which are outside of price action. Okay, so the monetary environment, crowd psychology, valuation, economic conditions, so these kind of things which are external factors which will affect the markets, they come under external indicators. We also tend to include economic indicators that can influence the market, like inflation in the monetary category, and sometimes to a lesser extent the sentiment category. So basically we're looking at two sets of external indicators. So we are also seeing monetary and we are also seeing sentiment indicators. To analyze them, we can use the identical arsenal of measures we used for internal indicators, including moving average, momentum, and deviations from trend. My introduction to model building started in 1984 when Ned taught me the basics of creating what he called timing models. I was introduced to his models with names like Big Mo, Little Mo, Lexi, Bondito, and Bondo Grande. There was also the economic timing model and inflation timing model. He had models on 600 stocks, on gold, all the major currencies, crude, you name it. I was dizzy looking at all these models, and yet his approach to constructing them was amazingly simple. Find some indicators that work, give them all equal weight by assigning plus 1 0 or minus 1 to each, and add them up. I had cut my teeth on much more complicated systems. This was a whole new ballgame. I came to believe that Ned had invented a simplified version of multiple linear regression, which makes predictions based on the relationships between dependent and independent variables. And the beauty was not only in the methodology but in the results. Here, I thought, was the ultimate kiss: keep it simple, stupid system. But as it turns out, though the concept is quite uncomplicated, the process can be complex and time consuming. The devil is the details. Done poorly, it's garbage in, garbage out. Now, the reason why I'm reading this entire chapter is, again, this is a basic chapter, right? This is literally written in a format of a story. A guy is it's basically written in that format that you read the story and just understand the concepts. So I'm just helping you guys do that because there's not much for me to explain. Wherever there is a need to explain, I am pausing it and I am explaining it. I quickly learned the ropes and spent some serious time tweaking software and acquiring faster and faster computers. My objective was to keep several computers busy crunching models 24/7 in the hope of building more and better models while expanding our universe of trading vehicles. All of this was fine, but no matter how much output the computers generated, the process still required a researcher to handpick the indicators and the final model. Obviously, this was a limiting factor. By the late 1980s, I had written software to do actual picking, which paved the way for soup to nuts system for cranking out models. I was quite proud of myself and began building individual equity models. However, many of these models didn't work and some gave them losses. To remedy the problems, he tweaked the programs, for example, limiting the amount of RSI indicators and so on. After that, finally, I realized that a truly diverse objective model requires finesse, diligence, a bit of artistic panache, and a strong knowledge of macroeconomic relationships ranging from company fundamentals to macroeconomic fundamentals to Fed watching. Ironically, computing power takes a backseat in building good models. All right, so that was just the story which he um, narrated. Now let's come to the overview of the Fab Five. Now, this is the actual important concept in the chapter. To create the Fab Five, we combine individual models covering our favorite areas of the market. The name comes from the famous basketball team that my alma mater, the University of Michigan, had in early 1990s. However, the model only has four components. The first thing is sentiment, the second thing is monetary readings, third thing is combo, and the tape. Sentiment, monetary readings, combo, and tape. Tape is given double weight. Keep that in mind. I start with it because it accounts to the two-fifths of the Fab Five. What is two-fifths of the Fab Five? It is tape. Now let's see what tape really is. Figure 32.1. Okay, this is the figure 32.1. Okay, and I don't know if you can see this, but it's giving you S&P 500 index and model allocation line. Bottom, you have Fab 5 composite model. Okay, all right. The mode boxes at the bottom summarize the results for the full date range as well as for the past 10 years. The top clip has an additional series on it represents an equity line. Okay. Now let's talk about tape. What is tape component of the Fab 5? There are 7 individual indicators in the tape component. As with all the other Fab 5 components and keeping with our kids' philosophy, these indicators are each assigned -1, 0, or +1, and the result is produced through simple addition. So, tape component basically consists of 7 individual indicators, and all of the indicators have value of either +1 or 0 or -1, and then a simple arithmetic addition is done to get the answer. The simple trend following indicator is what technical analysts call a golden cross. So you know what golden cross is? When a smaller term moving average crosses a bigger term moving average. So if you look at the figure 32.2, you can see this diagram. We are using a 50-day moving average and a 200-day moving average. Whenever the 50-day moving average crosses the 200-day moving average from below, then it generates a buy signal. And whenever the 50-day moving average crosses the 200-day moving average from the above, then it shows a selling signal. So this is the first and following system which comes into account in the tape component. All right. The box on top part shows the indicator's performance. At NDR, the box is called a mode bat. Ned invented this in the late 1980s, and it shows what the returns have been when buying during the bullish mode or the bearish mode. It tells us that 50-day has been above the 200-day nearly two-thirds of the time, and that during those times the S&P 500 on a price only basis has returned 9.1% per annum. Obviously, an indicator like this is a long term, designed to catch major moves. The indicator in the chart 32.3 is a typical trend sensitive indicator. Let's see what 32.3 is showing. 32.3. Okay. So this is basically showing a stochastic NDR. Okay, and it has a 5 day smoothing. Now let's talk about this. It is a trend sensitive indicator. We know what trend sensitive indicators are, and it is called stochastic, which measures variation in momentum. The idea is to look back a set number of market days, pick the low and the high in that period, and calculate where the market's current value is in relative to that range. The result is a percent. 100% is a new high, while 0% is a new low. The ambivalence of this indicator is reflected in whether you want to catch a thrust early and go long, called a bracket if you're going long, and wait until the thrust is over and then go shorts, which is called a reverse bracket. It can be used either way depending on the number of market days being looked at, whether a moving average is applied, and how wide the brackets are. This chart signals are summarized in what is known as the batting average or BAT. NDR, since its inception in 1980, has been using bats to evaluate indicator. We know what bats are. Bats are the tables which they are creating. Now, the first criteria of this model which we saw was the moving average crossover. The second thing which we saw was a trend sensitive indicator, and in that we spoke about what stochastic is. Stochastic takes a particular high and low range and calculate the high and low, and we get a value for the same. And how do you overall get a value? Overall, you get a value by having. So right now, what we're seeing is the tape, right? So tape is the thing which is given double the weightage in Fab 5. You need to keep that in mind. If you are getting confused, then make sure to make notes and make sure to rewatch this video. Then it will be easy for you. The factors used include how accurate the long signals have been and what the overall annualized return has been. To illustrate a practical use of this indicator, figure 32.3 assumes that on sell signals for stocks, an investor will buy T-bills rather than short the market. This 85-day stochastic is derived from NDR's all cap equal weighted index based on our full broad market equity series universe. It is equally weighted and rebalanced quarterly. The result is smoothed with a 5-day moving average and has brackets at 11 and 65. 11 and 65. As the chart points out, a buy signal is generated when the smoothened result dips below then rises above 11, while a switch to T-bills is signaled when the indicator crosses above and then below 65. Okay, so I hope you understood this. Whatever result we have, we are going to smooth it with 5-day moving average, and it has a bracket of 11 to 65. Whenever result dips below and then rises above 11, um, then you buy, and whenever the price goes above 65 and then comes down, then you are going to basically sell. Okay, to generate a signal, the indicator either has to cross above the upper bracket and then cross below the upper bracket, or cross below the lower bracket and then cross above the lower bracket. The indicator can go neutral, If a signal is given across the upper bracket, that signal stands until either the indicator drops below the bottom bracket and then crosses back above until the bottom bracket, or the indicator crosses back above the under bracket before crossing the lower bracket. If the latter happens, the indicator becomes neutral. I call this an oops signal. So, what is an oops signal? An oops signal is when you have a neutral signal. The bottom bracket is treated only the same way. The reverse bracket indicator has been negative only 19% of the time, neutral 25% of the time, and 56% of the time positive. Moving away from direct price action, we turn to one of our favorite broad market tools, which is breadth. This indicator is one of Ned's favorite. It is based on another fairly simple yet effective concept, evaluating the impact of volume supply and volume demand. You know what breadth was? Breadth was evaluation of the market volume and volume supply and volume demand. If a stock advances on a day, we'll consider all the volume traded on the day to be advancing volume, and in case of if a stock falls on a day, then we will just consider that the entire volume was on the supply side. So that is what is known as the breadth. To stabilize volatility and gain a useful perspective, we typically sum both supply and demand over a substantial period ranging from days to months. The percent of summed supply volume plus the percent of sum demand volume always adds up to 100. So, this is also something you need to keep in mind. Supply plus demand is not going to be equal to 1. In fact, supply and demand is going to add up to give you 100. They meet in the middle at 50%. The universe we are using for this calculation is the NDR Broad Market Equity Series All Cap Index. This index represents calculation in the it represents 99% of the market value of the common shares trading on the big three exchanges. Its history goes back to September 1980. The mode box in figure 32.4. Now let's see figure 32.4. So we have NDR supply and demand given, and we also have the S&P 500. The mode box in figure 32.4 shows that when demand has been above supply, as it has been 79.1% of the time, the S&P 500 has advanced. When the supply is above demand, the market retreats. Okay, this is figure 32.4. So if you look at the figure properly, you can see, right? You can see how the S&P 500 correlates with the supply and demand, and how it reacts when the supply is more and how it reacts when the demand is more. The reason why I'm not looking into the graph is because we have done this in the um, indicators chapter, right? When we also saw about what market breadth was. So you can see that the dotted, you can also note one thing over here. The figures which they've given here are according to the Ned's model. All right. Where were we? Yeah. The indicator's contribution to the Fab 5 tape component is +1 when demand is above supply and -1 otherwise. So whenever demand is more, we have +1, and whenever supply is more, you have -1. There are many ways to look for excitement in the stock market. Exuberance, whether rational or irrational, can be measurable. A couple of our favorite indicators look at the relationship between advancing and declining volume, or advances versus declines. Figure 32.5 evaluates the ratio of advances to declines. The ratio is actually a 10-day sum of NDR multi-cap advancing issues divided by a 10-day sum of declining issues. So advancing divided by declining. The NDR multi-cap universe covers the top 97% of tradable market cap and includes the NDR large cap plus the NDR mid cap plus some of the NDR small cap, enough to get the market cap to 97%. When the advance decline ratio exceeds 1.9, we call that a breadth trust. The table in figure 32.5 shows the history of this indicator back to 1947. Okay, so you know what breadth thrust is, right? There can be an MCQ on it. So whenever the advance and decline ratio exceeds 1.9, we can call it a breadth trust. All right, what you're thinking? Hold on. If the multi-cap started in 1980, just exactly how do you do this? Especially given that lecture about following only common stocks on NYSE. Well, we consider ourselves market historians and we love historical data as much as we can get. So, yes, we borrowed the NYC advanced decline data going back to 1947 to help illustrate the point that breadth thrust can be quite significant. It also turns out to that according to our database, stocks other than common stocks made up only 20% of listed NYC issues in 1980. Now, how exactly do we get thrusts to work for us? Typically, we try to determine how long initial momentum is likely to last based on history and then refine our prediction from there. In the case of the indicator shown in 32.5, 80 market days seem to work well. But what if a signal is repeated in that period? One could approach in the least 2 days, either by simply resetting the count every time a new signal occurs in the 80-day window or by ignoring that signal. After some quick testing, we decided on the latter. The contribution of this indicator to the Fab 5 component is either plus 1 or 0, it can never go negative. If there was a cool breath gauge, the high-low logic indicator developed by Norman Fussback is shown in figure 32.6. So in figure 32.6, we have the indicator over here. Okay. All right, let's also read about it. Let's read about Norman Fussback. It is basically a measure of how in gear or bullish the market is. So, in gear, what do you mean when you say that the market is in gear? It means that the market is accelerating towards the upside or the market is going up. That is what is known as high. That is what is known as the market gear or bullish. I'll admit it. If I was quite baffled by this at first. How could a single indicator with opposite messages give the same signal regardless of the message? Well, the market is considered in gear when new 52-week highs overwhelm the new 52-week lows. It is also in gear when the new 52-week lows overwhelm the new 52-week highs. The rest of the time, the indicator is either neutral or out of gear. So, out of gear is bearish. The high-low logic is calculated by taking the ratio of either new 52-week high or new 52-week lows, whichever is less, to the total number of issues and smoothing the ratio with a 10 moving average. Fospack's original work used in NYC data back in 1941. Here we use the NYC in combination with the NASDAQ and the AMEX for a broader look. This also helps us to get past with our issue with the NYC listing by adding in higher concentrations of common stocks. Here's a next view of concept. Since market tops are typically slow to form, the increased risk of peak is evident when the quality market averages are reaching higher levels without confirmation from increasing numbers of 52-week highs, whereas a churning or out of the gear market is more effective as an indicator of tops after rallies. Upside confirmations indicates that the market is in gear and that current uptrend is healthy. Since market bottoms are usually formed relatively quickly, it is also bullish when the market is at gear or at selling extremes characterized by new lows on the vast majority of stocks, a sign that a selling climax has left the market oversold. When many stocks are making new highs at the same time that many are making new lows, the index reading high indicates a divergent markets. When few stocks are diverging from the prevailing trend, the index is reading low, a reflection of confirmation. In other words, high index readings reflect widespread divergence, which is bearish, whereas low index readings point to bullish conditions. A selling panic with almost no new highs, the sign of an extremely oversold market, or a selling vacuum with almost no new lows, the sign of the market with strong upside momentum. The indicator is able to identify new bull markets with buy signals while remaining on sell signals during bear markets, rallies, or the blow off moves that tend to occur near the end of the bull markets. Another of our favorite breadth indicator is the diffusion index. Now let's talk about what is the diffusion index. It is more or less a consensus of certain measures for a host of similar vehicles. In this case, world stock markets relative to their 50-day moving average. Why 50 and not 83 or 27? We like to keep things simple, and virtually everyone is familiar with the 50-day moving average. Figure shows the relationship between global equity markets and the US markets. If 71% or more of global markets are above the 50-day moving averages, um, 50-day moving averages. The US market, as represented by NDR All Cap Index, appreciates at 32% per annum. Since 1980, this has occurred 41.1% of the time. So, I hope you understand what the diffusion index is. Whenever the global markets are at a majority above the 50 moving average, then the US market also is giving us gains. Conversely, when the percent of markets drop below 41%, the NDR all cap retreats 2.3% per annum. The contribution to the Fab 5 component is minus 1, 0, or 1. The 46 world markets are MSCI, Morgan Stanley Capital International, all country world index members, 23 developed economies, and 23 emerging ones. A long standing tenet of NDR is to go with MO. What is MO? If the market's momentum is up, we're in. If the market momentum is down, and then we are out. We use this model as a gauge of technical health. Big momentum is a diffusion index that represents the percentage of bullish individual trends and momentum indicator taken from 96 of our own BMES sub-industry indices. The trend indicators are based on the direction of the subsidiaries moving average, sub-industries moving average, while the momentum indicators are based on the rate of change of the sub-industry's price index. The ratio of momentum to trend indicators is around 2 to 1. In the past, we've had several versions of Big Mo. The first one I remember from 1982 used industry groups that were defined by S&P. We also had a daily version called Little Mo built with individual stocks. After developing our own geometric industry groups in the late 1980s, we rebuilt Big Mo. By the mid 1990s, having added to our stock database, developed our industry work even further and added new analytical techniques. We look we took another shot at it. The current version was created in January 2013. As fate would have had it, we were forced to we were forced into a rebuild due to data vendor technicality. We liked the old model but had a no choice but to rebuild. The indicator shown in 32.8 introduces a modification of our standard mode bat, the directional mode bat. The two mode boxes in the upper left results are based on whether Big Mo is higher or lower than it was 6 weeks earlier. In the bottom sections, the brackets are fixed at 56 and 79, and the results are quite different depending on Big Mo's direction. So you can look at this, and you can also look at the modes which are given, right? And it is basically the value of the Mo. It was 6 weeks before, and what it is now. All right. Whether the model is improving, rising, or weakening can give valuable information in addition to the model's current level. When Big Mo tape has been high and rising, the returns have tended to be best. While the Big Mo is low, then the returns are also weak. The weight of this indicator in the tape component of the Fab 5 is tricky but sensible. When Big Mo is rising and above 56, we assign plus 1. And when it is rising and below 56 it gets a 0. When it is falling and above 79 it gets a plus 1. If it is falling in between brackets it is a 0, and it is still following, then it gets minus 1 reading. So if the Big Mo is again unchanged on a 6 week basis, then the reading from the prior week is used. Okay, so you need to keep in mind the values of Big Mo. So whenever the Big Mo is rising and it is above 56, we give it a score of plus 1, and whenever it is rising but it is below 56, then we give it 0. Whenever it is falling and above 79, you again give plus 1, but when it is falling and it is between the brackets, then you give it a 0. Let's talk about the final tape component. Now that we have all our indicators, it is a simple matter to add them up to produce a result. Since there are 7 components to the model, the range should be minus 7 to 7. Plus, but remember the thrust indicator can't go negative. So the overall sum ranges from minus 6 to plus 7. The brackets for the model are set at minus 1.5 and 25.5. As with the components of the Fab 5, the model is designed to work in 4 separate time frames. Its contribution to the overall Fab 5 is minus 2, 0, or plus 2. And why are we saying that? Because you know that it gets double weight. All right, the sentiment component. Now let's again go into the detail of what the sentiment component is. We just discussed this briefly, but let's see how do we actually use it. During my initial interview with Net back in 1984, I was a bit nervous, to say the least. I really had no idea what Ned Davis' research was, and I had never heard of Ned Davis himself. Being new to Florida, I had been scanning the want ads when I came upon a two blurb for a statistical researcher. When I phoned the employment agency that had placed the ad, the woman there told me that the client was looking for someone with an MBA who could program in BASIC, a once popular computer language.
After I told her I had an MS, had recently worked for a research organization, and could program in BASIC, she set up an interview. No information about the company was forthcoming. I went in blind. The address was a house in a semi-residential area. I thought I had um, the wrong place until I saw a small weather-beaten signs in front of which said Ned Davis Research. I noticed a gleaming maroon Jaguar out back under a carport. My initial interview was in a converted bedroom. When I met Ned, he was wearing shorts, a t-shirt, and boat shoes. I felt a little out of place because basically he was wearing a new suit. As I sat there, Ned asked me if I knew the difference between a stock and a bond. My life flashed before my eyes. I had never read a newspaper's business section in my life. I had studied biology, chemistry, and statistics, and generally viewed business majors the way I viewed psychology majors, students from another planet. When I answered with a no, I thought it was curtains for my chances of getting the job, but as it turned out, Ned viewed my ignorance as a plus because it meant I had no preconceived notions about stocks and bonds. I was biased free blank slate. After several months of working for Ned, I began to perceive the relationship between investor psychology and markets. I realized I had gone from analyzing seasonal zooplankton population to analyzing what basically amounted to fear and greed. It's hard to find an investor or a trader or anyone for that matter who does not have an opinion on the direction of the stock market. From blogs to books to PhDs, from blogs to one second. From blogs to books to PhD dissertations to the media, we find no end to sentiment indicator pay dirt. The term irrational exuberance and the madness of crowds reflect the fact that we humans have a flair of exposing our hand. And what better place to show than the stock market? Fortunately, analysts and market historians have access to a small dashboard of sentiment indicators. These include polls of investors, newsletters, writers, professionals, non professionals, and so on. People who put their money where their mouths are. In addition, there are other ways of determining sentiment, for example, a high price, a high earnings, price or dividend ratio, and so on. The whole idea is to look for extremes in these indicators. When investors are at their maximum bullish level, that indicates a market top. When the vast majority of investors are bearish or have sold whatever they can sell, we generally find market bottoms. The trick is to detect these extremes. The sentiment component of the Fab 5 uses some of these concepts in its 7 indicators. Each indicator gives plus 1, 0, or minus 1 to the overall component, with one exception. Our daily sentiment composite, which gets double weight. So, whatever the daily sentiment is in this case, that's going to get the double weight. I wouldn't go so far as to call its name an oxymoron, but Investors Intelligence has been producing the Advisor Sentiment Report for over 40 years. This survey is one of our favorites. The firm tracks more than 100 independent market newsletters, classifying each as bullish, bearish, or on the fence. In figure 32.10, we're interested. Okay, this is 32.10. You can look at this extreme optimism, gloomy, extreme pessimism, optimism, gloom, doom. And this is basically the Dow Jones chart. This presents a longer term picture of how advisors are feeling given that its weekly